This asset crash is about to get worse, much worse. I'm talking even worse than 2008, because when I take a look at the combined value of the US housing market and stock market, I see that they're valued at over $80 trillion right now in the fall of 2022, which is absolutely insane because the size of the US economy, the GDP of America, is only $25 trillion. So literally, asset prices are 3 times higher than the size of our economy, indicating that we have another 30%, 40%, maybe even 50% to go in this market crash. And the problem right now for stock owners and homeowners and those who have a lot of assets is that as the Fed increases interest rates, that is going to incrementally degrade the value of their asset. Because the important thing to understand about all the value you see across the US economy today, whether it's stocks, housing, crypto, cars, you got to understand that those valuations were all based off artificially low interest rates, an artificially low interest rate environment that lasted for the last 20 to 25 years. As you can see on this graph, interest rates have just continually been going down over the last 3 to 4 decades. And we're basically close to zero for much of the pandemic. And that's what created the asset price bubble. As you can see on this graph, they're inversely related. The more that interest rates went down, the more that asset prices went up. But now that interest rates are starting to go up, we're seeing the asset prices go down, which means there's going to be some great buying opportunities for those of you who have been patiently saving your money and stockpiling cash. And the metric that I am looking at to tell me when the time to buy is going to be is a stat I developed called the asset price to GDP ratio. You can see today we're at 320%, 80 trillion in value in the housing and stock market compared to 25 trillion GDP. And the way you're going to know that it's time to buy is when this asset price to GDP ratio gets closer to the yellow dotted line, 200% of GDP. That is a more normal level historically. That's been the average of the last 50 years. To get to that average, we would need to see a 40% combined correction in both the housing and the stock market. Now, before going further into this video, I need to address kind of a question, an elephant in the room that I think is on a lot of your minds. You might be saying, Nick, wait a minute. How could this crash be worse than 2008? Like, that seems almost crazy to suggest, right? 2008 was so bad. How could 2022 and 2023 be worse? Well, folks, it's all about the data. It's all about the fundamentals, right? Because when we look back at this asset price to GDP graph, we can see 320% today is lower than what it was 6 months ago when it was 380%, but it's still above the peak of the 2007 bubble. It's still above the peak of the 2000 bubble, which is absolutely crazy, everyone, that even with the recent correction in the stock market and housing market, we are still in the biggest asset bubble of all time.
And this is ultimately why I think this crash is going to be worse than 2008, because home prices, stock prices, they have a long way to go down still to get to a level that is more fundamentally supported by the size of our economy and the amount of money people make. And that's ultimately what we're doing by comparing values to GDP. We're setting a standard for what asset prices should be given the size of the economy. And these Fed rate hikes that are causing the initial decline in asset prices, this is just the start. Because right around the corner after these Fed rate hikes is a recession that's about to get a lot worse. There's going to be job losses. There's going to be unemployment claims. They're going to cause consumption and demand in the economy to go down further, which is of course going to lower asset prices back down to a more long-term sustainable level. And the warning signs for this are just getting louder and louder and louder. For instance, we have Credit Suisse, one of the biggest banks in the world, having all types of issues right now. They're having difficulty raising money. Their credit default swap spreads are surging. Their stock prices collapsing. A lot of people are betting that Credit Suisse could be this recession's version of Lehman Brothers, where we see a big world financial institution go under that causes a contagion effect and that causes the downturn to be even worse.
Additionally, we're seeing problems globally. Great Britain almost had its own Lehman Brothers event just 2 weeks ago when they had a bond market rout that caused bond yields to surge from 3.5% to almost 5% in a matter of days. That was due to the new British government announcing tax cuts that were unfunded that were going to increase the debt by $50 billion. Bond buyers said, screw you, we're not going to buy UK gilts anymore. That caused interest rates in Britain to go up, which almost crashed their pension fund system, and the Bank of England had to step in and say, we're going to buy bonds as a last resort to support the market. So these things are canaries in the coal mine. They're big warning signs that real problems are ahead in the overall economy. And of particular concern to me right now is what is going on in the energy sector with prices of oil and gas. We saw oil went down actually by quite a bit over the last couple months. There was some deflationary pressure in oil prices, but now oil prices are starting to shoot back up because OPEC just announced that they're going to cut production by 2 million barrels a day. So that's likely going to cause your gas prices at the pump to increase significantly over the next month or two, which is a big problem for the US economy, because potentially the one positive in all of the things that have happened over the last couple of months was that gas prices went down. Well, now if gas prices go back up, just as the Federal Reserve is aggressively hiking interest rates, well, that's going to be curtains on the US economy, especially for the US consumer, everyone. I mean, the US consumer is already running out of money or has run out of money. The statistics we're seeing on things like credit card debt, on the personal savings rate in America, are suggesting that there is not much left in the tank for the average American to spend to support this economy. And that personal savings rate metric is one that I'm watching closely. It's one that you should be paying attention to because it's really a signal, a barometer of how the average American household is doing. The statistics reported by the Bureau of Economic Analysis, and they simply measure the percentage of disposable income that's saved into a savings account or a bank account by the average American. And right now, in the most recent month, that was 3.5%, a 3.5% savings rate, which is well below the long run average of nearly 8% and almost as low as what occurred in 05-06 before the great financial crisis. And so the less that Americans are saving, the more that's telling you they are having financial difficulty. They are having financial problems. They're not going to be able to afford discretionary spending. They're not going to be able to afford to go to a restaurant. Americans aren't going to be able to afford to go to a ball game or to buy a TV or to buy a house. And it's going to cause the prices actually of all these things to go down into the future, in my opinion, because I am predicting, despite the surge in gas prices and despite the stubbornly high inflation, I'm predicting deflation is right around the corner, because you can only increase prices so much until you break the economy in half. And that's essentially what OPEC is doing right now. They want to cut supply to boost prices. Well, okay, good for you. But people around the world don't have money to pay higher prices. I mean, how could the average American, if the savings rate is 3.5%, pay more in gas prices? It's not going to happen. Americans are going to drive less, they're going to consume less, and the worldwide economy is going to crash, which is going to create a deflationary episode that actually, in the long run, is going to cause interest rates and mortgage rates to go back down. And finally, everyone, I want to leave you all with just some actionable advice in this video. Like, what can you do with the information I presented on the asset bubble and where the economy is going, and how can you make better decisions with your money and with your career? And my number one suggestion, as it's been for the last 6 months, is to stockpile cash. Cash has been one of the best performing assets, actually. Despite inflation, cash has done much better than the stock market, than crypto. It's done better than silver. It's done better than gold. By the end of the year, it's going to be doing better than housing. So holding cash is so key, because it's going to give you the opportunity to pounce on these declines in stock prices, on these declines in home prices that are going to continue into the future. But additionally, perhaps even more importantly, cash gives you flexibility in your life, in your career, because we have very uncertain times ahead. There's going to be lots of layoffs. There's going to be lots of bankruptcies. I don't say that to scare anyone. I say that because it will be the reality. We're already starting to see it. And if you are someone who potentially gets laid off into the future, or maybe struggles at your job, maybe your wages get cut or your hours get cut, or maybe this downturn reorients what you want to do in your life, you're going to want to have cash on hand to pay your bills, to give you the flexibility to shift and change your career as needed. And this is something I feel very strongly about, given my experience. In 2020, when I quit my old job and started ReVenture Consulting, before this YouTube channel really started taking off and before I had clients for consulting, I made very little money. I just spent about $20,000 out of my savings in 2020 and early 2021 to cover my living expenses, because I didn't have income coming in. And that was a period where I wasn't feeling great, where, my prospects for the future I was unsure about, but it was a period that was so necessary in allowing me to develop my company and this YouTube channel. And it was made possible by me having cash on hand to give myself some flexibility. And so I just wanted to put that out there. I know a lot of people think of this squarely in terms of having cash to buy a house or buy stocks when they get cheaper, but it's also really valuable in case you're someone who's going to go through a life transition or a career transition during this downturn downturn to have that cash and that flexibility to do it. Now, lastly, guys, I would love your feedback and your help actually in the comment section below. If you are someone who is starting to see signs of the recession in your city, in your neighborhood, in your state, in your country, even if you live out of America, can you comment below and let me know what you're seeing? Because I'm starting to hear more and more things about a friend of a friend got laid off, or a friend of a friend got their hours cut, and we're not really seeing this show up yet in the government jobs data. The government jobs data still looks strong, but I suspect there's something boiling under the surface, and I would love to hear some feedback if you guys are seeing certain things out there, or maybe you're not actually seeing signs of a recession out there. Either way, comment below. You guys are my eyes and ears on the ground. I want to hear what you're seeing. When you guys comment, it makes these videos better.